Welcome to this amazing and wonderful chapter again, Advanced Capital Budgeting. We have yesterday took one question number 78. The question is whether to open the gold mine now or whether to open the gold mine after 1 year. Today the price is 5,000 rupees and the price can rise by 500 or fall by 500 from the previous level. So these are the possible prices in year 1. These are the possible prices in year 2. These are the possible prices in year 3. So first we'll find out what will be the expected price. What will be the expected price in year 1, year 2 and year 3. If you look at this 5500 and 4500, there is a probability of 0.5, 0.5. But what about probability of 6,000, 5,000, 5,000, 4,000? Can you say probability of them, each of them is 0.5? Can you say probability of each of them is 0.5? Only say yes or no. Can you say probability of year 2 6,000 is 0.5? The answer is no. If you say probability of each of them is 0.5, the total probability will become 2. That will be a gross mistake. Is it right? In year 2 we have 4 possibilities. Each possibility is equal. So probability of each of them will be 0.25. Probability of each of them will be 0.25. Or you can multiply 0.5 into 0.5. You will get 6,000 in the year 2. If you get 5,500 here, whose probability is 0.5, and you get 6,000 whose probability is 0.5. So probability of getting 6,000 in second year and getting 5500 in the first year will be the joint probability. So the answer would be individually the probability of each of them will be 0.25. There are 4 possibilities. There are 4 possibilities in year 2. Or you can simply take joint probability, you will get 0.25. One more old boring question. What is the probability of each of these numbers in year 3? What is the probability of each of the number? You will get 6500 in year 3. What is the probability? In third year we have 8 probabilities. 8 possibilities and all of them are equiprobable. All of them are equiprobable. So the probability is 1 by 8, 0.125. So probability of cash flows in year 1 is 0.5, year 2 is 0.25, year 3 is 0.125. Keep this in mind and then we can solve the problem. Is it right? So first write down below that diagram, or we will give it diagram number 1 so that you will remember. Give it diagram number 1 because I have to draw one more diagram. Diagram number 1. Now write down below expected price level at the end of year 1, expected price level at the end of year 1. Question in front of you, diagram in front of you. The expected price level in year 1 will be 0.5 into 5500 plus 0.5 into 4500. So check the answer please. It will be 5,000. It will be 5,000. Now write down expected price level at the end of year 2. Expected price level at the end of year 2, there are total 4 possibilities. Each possibility will have a probability of 0.25. Please solve and give me the answer. Solve and give me the answer. The answer is how much? Anybody? If you don't reply, I will not be able to move ahead. What is the expected price level at the end of year 2? What is the expected price level at the end of year 2? Just check, is it 5,000? Is it 5,000? And similarly, what will be expected price level at the end of year 3? Expected price level at the end of year 3, you have to multiply by 0.125 into all those numbers at the end. So these are the numbers. You have to multiply by common number 0.125. So you can put 0.125 common, and in the bracket you can write all those 8 numbers which are appearing in the year 3. All those 8 prices which are appearing in year 3. So I will request you to please give me the answer. Yes, please reply. What is the answer? 5,000. Very good. So what is the moral of the story? The moral of the story is, if the price is 5,000 today, and if it rises or falls by equal amount, then expected price in all the future year will be 5,000. The moral of the story is, if it is 5,000 today at the beginning, and if it rises by 500, falls by 500 with 0.5 probability, the expected price level in all the 3 years will be 5,000 rupees. So if I start the gold mine today, I am expecting to receive 5,000 rupees per ounce of gold every year. This is my expected price in the coming 3 years if I start the mine now. And what is my extraction cost? Extraction cost is 4,600. Extraction cost is 4,600. So you are going to earn a profit of 5,000 minus 4,600, 400 rupees per unit, and you can extract 1,000 ounces of gold every year. So let us calculate the NPV now. Write down calculation of NPV. Calculation of NPV. Draw the format year, particulars, cash flow, discounting factor at 10%, discounted cash flow. Very important question for 20 marks. Take it seriously. If it is asked in your exam again, and if you have not practiced, you may find it difficult. Year 0. Year 0, cost of opening the gold mine. Cost of opening the gold mine. How much is the cost of opening the gold mine? 10 lakh rupees. Cost of opening the gold mine, 10 lakh rupees, which is given. And 1, 2, 3, 1-3, first 3 year, you will get cash flow after tax, or you can just write down annual cash inflow. Annual cash inflow, 5,000 rupees is the price of the gold. 4,600 is the extraction cost, and 1,000 is the quantity. 1,000 is the quantity. So the answer is 4 lakh rupees. Just check 4 lakh rupees. Present value factor is 1. For 1-3, 2.4869. For 1-3, 2.4869. 2.4869 multiply, this is 10 lakh, and multiply this 994,760. 994,760, and therefore the NPV is 5,240. If you open the mine now, your NPV will be 5,240. The value of this project is negative. What will you do? Will you open the mine now? Will you open the mine now? Yes or no? With negative NPV, would you open the mine now? Yes or no? The answer is no. Write down one note here. The mine should not be opened now. The mine should not be opened now because NPV is negative. Because expected NPV is negative. It is not generating your target return of 10%. Negative NPV means you are not getting target return of 10%. So this is my first answer. We have to give 4 answers. NPV, if you start the mine now but without abandonment option. Now we are going to calculate NPV if we postpone the opening of mine for a year. If I postpone the opening of mine for a year, I will be able to know whether gold price has risen to 5500 or gold price has gone down to 4,500. Is it right? Now write down situation 2. Situation 2. Open the mine after 1 year. Let us do the analysis. What will happen if we open the mine after 1 year? We are solving one of the best questions in this study material. Okay, not just capital budgeting topic, but any topic put together. Question for 20 marks are very rare in the exam, but they have asked it. So now draw the diagram first. Draw the diagram first. We have 2 options. One is to open the mine, one is not to open the mine. If we open the mine, we'll wait for a year. We'll wait for a year when the price will be 5,500 or 4,500. After year 1, price will be either 5500 or price will be 4500. If it is 4500, please answer quickly. Okay, please answer quickly. Keep your typewriter ready. If the price is 4,500, what will be expected price of next year? What will be expected price after getting 4,500 in the subsequent year? We have discussed just now, if you start with 5,000, expected price will be 5,000. So if you start from 4,500, your expected price for all the subsequent year will be, expected price will be 4,500. Expected price will be 4,500. You can try yourself. 5,000, 4,000, 4,000. If multiplied by probability 0.5, you'll get 4,500. Would you open the mine after getting 4,500 after year 1? Would you open the mine even think of opening the mine after getting 4,500 after 1 year? The answer will be no, because my expected price for second year, third year, fourth year would be 4,600, 4,500, but the extraction cost is 4,600. My extraction cost is more than the expected price, so I will just stop here. I will decide not to open the mine only, no calculation required. A man on the street can also say, if my cost of extraction is 4,600 and my expected price is 4,500, it's a loss making proposal, so let us not open the mine only. But if the price is 5,500, my expected price for future year will be 5,500, which is more than extraction cost. At least I will sit down and do calculation, but here no calculation required. I will not start the mine at all. So write down the diagram. The diagram will proceed further here only. It will not proceed further here. Common sense is, if you get 4,500, do not open the mine here, because there is no positive contribution. So my diagram will not move further beyond that. But if I get 5,500, I will move further. I will have to check my answer also, but first you draw the diagram. First you draw this diagram. First you draw this diagram. Price will go up, price will go down by 4,500 by 500 rupees. Oh my God, such a difficult diagram. Yes, it is difficult. Who said our course is simple? Now you can draw it nicely. Take your time. This is the full diagram now. This I will call diagram number 2. This we will call diagram number 2. This I am going to call diagram number 2. Once you have drawn the diagram, please inform me so that I can proceed further. Once you draw the diagram, please take the effort and say, sir, we have done. You can go further. Have you done diagram? Okay. Now we'll move to the next calculation. I am going to explain one more time. We'll wait for a year. After a year, the price can be 5,500, 4,500. If it is 4,500, I will not open the mine because the extraction cost is more than expected price. If it is 5,500, I will at least do the calculation and see whether NPV is positive or not. So from here the price can be 6,000, 5,000, 6,500, 5,000, 5,000, 4,500, like this. As we discussed earlier, if I am starting from 5,500, my expected price of year 2 will be 5,500. My expected price of year 3 will be 5,500, and my expected price of year 4 will be 5,500. At least we are in a position to do calculation and check NPV is positive or not. So write down below, I will give you a note for future understanding. In case if you revise it, it will be very useful to you. So please write this note. If the price of the gold comes down to rupees 4,500 after 1 year, the expected price level in all future years, the expected price level in all future years will be rupees 4,500, will be rupees 4,500, which is lower than the extraction cost, which is lower than the extraction cost, that is rupees 4,600. Hence, the mine should not be opened. Hence, the mine should not be opened after year 1. After year 1, if the price of the gold, comes down to rupees 4,500, if the price of the gold comes down to rupees 4,500, expected NPV will be 0, because if you are not going to open the mine, there is no cost, there is no revenue, there is no extraction cost. In expected NPV, if the price goes down to 4,500, is rupees 0. Okay. Now write down next note. If the price of the gold, goes to rupees, if the price of the gold goes to rupees 5500, if the price of the gold goes to 5500, the expected price level of gold in all future years, the expected price of gold in all future years will be rupees 5500, will be rupees 5500. Is it right? Will be rupees 5500, will be rupees 5500. So I don't need to calculate 5500. We have understood, if you start from 5500 and the probability is 0.5 and 0.5, rise and fall is by equal amount, 500 and 500, your expected value will be 5500 only. So write down please, calculation of NPV, right below, calculation of NPV if the price of the gold goes to rupees 5500, if the price of the gold goes to 5500 in year 1, if the price of the gold goes to rupees 5500 in year 1. Now draw the table for NPV. First column write down year, second column particulars, third column cash flow, discounting factor at 10% and discounted cash flow. Right? Now when are we going to open the mine in this question? We are going to open the mine in the second situation, in year 1, not now, year 1. So this is a potential mistake area. Some students were trying to write year 0. Yes or no? Honestly tell me. You are planning to write 0 here, but you are not opening the mine in year 0. You are opening the mine in year 1. So why would you write 0? Cost of opening the mine. Question is silent. What happens to the cost of opening the mine? So we will assume cost of opening the mine after year 1 will also remain 10 lakh, will not change. If they say it will change, then take the changed number. Discounting factor is 1. And then we are going to generate cash flow in year 2, 3 and 4. If you open the mine in year 1, cash flow will come in year 2, 3 and 4. 2-4. 2-4. Come on student. Your cash flow will be 5500 into 4600 minus 4600 into 1000. 5500 minus 4600 into 1000. How much is the answer? How much will be your annual cash flow? Anybody? 9 lakh, very good. 9 lakh is right. And then you compute the present value. 0.9091, 2.2607 is the factor. Multiply please. Multiply please. 9,09,100. 2 to 4 multiply please. 20 lakh 34,630. Very good. Who will give me NPV? Who will give me NPV? Yes, dear student, please compute NPV. NPV, net amount. Anybody NPV? 11,25,530. 11,25,530. So if you open the mine after 1 year, when the gold price is 5500, NPV is 11,25,530. If the gold price is 4500, NPV is 0. The probability of getting 5500 is 0.5. The probability of getting 4500 is 0.5. So what will be my expected NPV if I wait for a year? What will be my expected NPV if I wait for a year? This is not the final answer. You can get this amount with 0.5 probability only. Okay, another possible mistake area. Student think this is the NPV. This is not NPV. This is NPV if price is 5500, but price can be 4500 also. We are standing today and I have to take a decision whether to start today or after 1 year. After 1 year, there are two possibilities. So I have to take expected value of those two possibilities. Write down a note. Write down a note as the probability of price rising in the first year. As the probability of price rising in the first year is 0.5. Is 0.5 only. So this has a probability of 0.5 only. The second probability is 0.5 if price is going down to 4500, but at 4500 my expected NPV is 0. Therefore expected NPV is equal to 0.5 into 11,25,530 and plus 0.5 into 0. You can write this also. This is you will get if the price goes down. This is you will get if the price goes up. So the student will now reply the final answer for situation 2, 562,765. 562,765. 562,765. Okay. Now this is positive. This is positive. Think about it. If you start the mine now, your NPV is negative. If you wait for a year, expected NPV is positive. What would you do? Would you start the mine now or would you start the mine after 1 year? After 1 year. Wait for 1 year. Wait for 1 year. Very good answer. Wait for 1 year. Okay. Should you appear in the exam now or after 1 year? Okay, like that. That is what students think. You can use this example for decision making. So write down the decision for the first question. If they only ask you the first question, whether we should open the mine now or after 1 year, this is your answer. So sometimes they will not give you full question. They can only give you first part of the question, now or later. So the answer is the company should open the mine after 1 year only. The company should open the mine after 1 year only if the price rises to rupees 5500. If the price rises to rupees 5500. if the price rises to rupees 5500. This is first answer, answer A. What was question number A? Should you open the mine now or delay 1 year in the hope of a rise in the gold price? So I am sure you have understood this answer. The next question is, I'll read the question from your book. What difference would it make to your decision if you could costlessly but irreversibly shut down the mine at any stage? You can costlessly but irreversibly. Costlessly means no cost of shutting down the mine. Irreversibly means once the mine is shut down, then you cannot reopen it again. It is shut down forever. Show the value of abandonment option. Again we'll have to solve twice. Now you don't have to draw the diagram because it will take again lot of time. This was my diagram number 1. Do you remember diagram number 1? Go back to that diagram in your notebook. Go back to that diagram in the notebook and find abandonment point. Find abandonment point. Abandonment point should be such that if you continue after that, your expected price will be less than extraction cost. Your expected price will be less than the extraction cost. Okay. So I am asking you one question. When would you abandon this project if you have the option to abandon? Go to diagram 1, situation 1. If the mine is opened now, there are two abandonment points. Wait, one is here and one is here. Is it right? If you abandon at this point, you will save the losses because next year the price could be 4,500 or 3,500. Can you see that? I have highlighted it for understanding, which means the expected price, if suppose you have reached here, the expected price for the next year will be 4,000 rupees. 4,500 into 0.5, 3,500 into 0.5, so expected price is 4,000, which is lower than the extraction cost. Then what about this point? Now here we have two paths opening up. After getting 4,500, next year you may get 5,000, or the next year you may get 4,000 rupees. But if you get 5,000 rupees in the next year, then you can go to 5,500 and 4,500. So you can enjoy this gain because expected price will be 5,000. You will enjoy the gain. If you terminate the mine at this point, it is irreversible. So you will not be able to enjoy the gain of the future year because the price can go to higher amount also, 5,500, and you can get some positive gain out of it. So I would abandon at this point. I will abandon at this point so that the future losses can be fully avoided. After continuing, if I get 4,000 in year 2 and if I continue, I am definitely going to suffer the loss. But if I abandon here, I am not definitely going to suffer the loss because there is a possibility of getting 5,000 or 5,500, 4,500. But once you abandon the mine at this point, it is irreversible decision. So write down 4,000 in the diagram 1 only. In the diagram 1 only, please go. Use a different color pen if you have, and write down 4,000 is the abandonment point. 4,000 is the abandonment point. At this point we should abandon so that we can prevent or avoid the losses of the subsequent year. Is it right? First tell me, is it right? Just say, is it understandable? Abandonment point, yes or no? Are you able to understand? Yes, very good. First year I will continue as it is. Second year up to this I am going to continue as it is. So year 1 and year 2 cash flow will not be affected. Year 1 and year 2 cash flow will not be affected. But in year 3 I will get only this first 6 cash flows. These two I will not get now, because if I get 4,000 here, then I am going to abandon the project. So the last 2 cash flows will not be considered in my calculation. So my year 3 cash flow, which earlier we considered 4 lakh rupees, will be more than 4 lakh, because the losses which we considered in the original question for these two situations, those losses can be avoided. Those losses can be avoided. Is it right? So my question is, because you are intelligent student, what will be cash flow of year 3? First I will give you 30 seconds to try. What will be cash flow of year 3 with abandonment option? Suppose you abandon the project after getting 4,000 in year 2, then this 2 will not be required. My question is, I hope you understood. If you have not understood, once again, what is expected cash flow of year 3 if project is abandoned, at rupees 4,000. If project is abandoned at rupees 4,000. If project is abandoned at rupees 4,000. Okay. So please solve. I'll give you 30 seconds. Year 1 and year 2 cash flow will not be affected. Year 1 and year 2 cash flow will not be affected. But year 3 cash flow will go up because of the avoidance of the loss in the last 2 scenario, last 2 possibilities. Anybody who would like to answer? Year 3 expected cash flow. Year 3 expected cash flow. You have to also multiply by 1,000 ounces. You are going to produce 1,000 ounces also. Okay. You are going to produce 1,000 ounces also. So while calculating your final answer, you have to ensure you multiply by 1,000 ounces also. So I have not received any answer till now. You are still in the thinking process only. That is the big problem with the students nowadays. They don't bother to reply you also. In spite of asking 15 times, they don't move only an inch. And we really stopped enjoying teaching now. It is more like a laborious task rather than an enjoyment activity. So many students are sitting, but very few are replying. Okay, write down. Note, write down. The company should abandon the project at the end of year 2. The company should abandon the project at the end of year 2 if the price level goes down to rupees 4,000. If the price level goes down to rupees 4,000. If the price level goes down to rupees 4,000. This is because the expected price level, of third year, from this point onwards will be rupees 4,000. will be rupees 4,000. Will be rupees 4,000. In bracket write 0.5 into 4,500 plus 0.5 into 3,500. Keep looking at the diagram number 1, which is less than the cost of extraction, which is less than the cost of extraction, which is less than the cost of extraction 4,600. So one thing is sure, we must abandon the mine after year 2 if we get 4,000 rupees, because there is no point in continuing knowingly that there will be loss. Yes or no? Yes. Now write down next point, calculation of NPV, calculation of NPV with abandonment option, calculation of NPV with abandonment option in bracket if mine is opened now, if mine is opened now, if mine is opened now and you have an abandonment option, you would be able to increase your NPV by how much? Let us see. And I have asked that question to you, but very few students replied. What would be the cash flow of the third year? Year particulars. Unless you learn to put stress on your mind, you will not be able to improve. Even if it is wrong, it's okay, but at least you have tried. Trying is more important than anything. Year 1 will not be affected. Year 1 I am going to continue 4 lakh. Year 2 will not be affected. I am going to continue 4 lakh. But year 3 will change. Year 3 cash flow will change. Refer working note below. Refer working note below. Keep 2 lines blank or 3 lines blank. Write one working note. Write one working note below. Keep looking at diagram number 1, third year. Diagram number 1, third year. Only we are going to take first 6 numbers. Only we are going to take first 6 numbers in the calculation. I will not take the last 2 numbers in the calculation. Last 2 can be avoided. Probability of each number. Probability does not change. Probability remains 0.125 only. You are not going to continue does not mean the share, the gold price will not fall to 4,000 or 3,500. Is it right? So probability will be same. Some of you have changed the probability. Am I right? Probability will not change. Possibilities are 8. We are going to only continue in the 6 possibilities. Other 2 will have 0 value for us. So 0.125 into bracket, if the price is 6500, my profit will be 6500 minus 4600 plus, if the price is 5500 and extraction cost is 4600, my profit will be this number. Third number same, fourth number same, fifth number same, sixth number same, and multiply by the quantity. Multiply by the quantity. 1000 is the quantity. 1000 is the quantity. So the answer is your cash flow of the third year will be 5,50,000. Nobody gave this answer, 5,50,000. This is cash flow of the third year. I will solve by one more method. If first method is difficult for you, I will solve by second method. This will also give me the same answer. This will also give me the same answer, and if this also gives me same answer, then you should be convinced. Okay, write down alternatively. First point A, write CFAT without abandonment option. If there was no abandonment option, my cash flow was 4 lakh rupees. If there was no abandonment option, cash flow was 4 lakh rupees. But if I have abandonment option, I can avoid the losses. I can avoid the losses by abandoning at the end of year 2. So add back loss avoided due to abandonment. Add back loss avoided due to abandonment. Now remember that diagram number 1, we will abandon at the point 4,000 rupees. The probability of getting 4,000 is 0.25 only. Probability of getting 4,000, if you want to write, you are going to abandon when gold price is 4,000. The probability of getting 4,000 is 0.25, and this was the loss which you would have incurred, but now you will not incur. The loss you would have incurred was expected price. This 4,000 is expected price, and this 4,600 is extraction cost. 4,600 is extraction cost. Is it right now? 4,600 is the extraction cost and 1,000 is the quantity. By continuing, this was your loss which you have avoided, and you have to also multiply by the probability 0.25. So are you getting 1,50,000? Are you getting 1,50,000? Yes. So loss avoided due to abandonment. Loss avoided due to abandonment is 1,50,000. 4 lakh without abandonment, 1,50,000 loss avoided. Therefore, your revised CFAT is 5,50,000. Revised CFAT is 5,50,000. So either you can solve like this or you can solve like this. I have given you both method of presentation. Any one can be followed in the exam. Okay. Any query on this? Then I am going to go to NPV calculation. Any query on this? Any query on this? Yes query or no query? No query. Very good. Have you understood? So this 5,50,000, you bring it here. 5,50,000 from working note 1 below, bring it here. Now you can compute the NPV. Now you compute the NPV. Write down the factors. Very good. Multiply cash flow with discounting factor and tell me the total. The total is how much? Anyone? Total of the last column? Total of the last column is something around 1,07,415. 1,07,415. So if I have abandonment option, then my NPV will be positive. But wait, I have to compare the two answers, now versus later. Whether we should start the project now or later. If I start the project now with abandonment option, this is my NPV. But I have to also calculate, what I have to also calculate? NPV if I start later with abandonment option. So this is my value of the project with abandonment option. In your first answer, you have computed the value of the project without abandonment option if you start now. There is a question in the book, what is the value of abandonment option? So please write down, value of abandonment option, value of abandonment option, value of abandonment option, value of abandonment option, write down NPV with abandonment option, NPV with abandonment option minus NPV without abandonment option, minus NPV without abandonment option, minus NPV without abandonment option. So right now my NPV is 1,07,415, the previous answer, and without abandonment option, my original answer, if you remember, negative 5240. So the total becomes, because minus minus sign will become plus. With abandonment option, the value of the project improves by, the value of the project improves by 1,12,655. Is the answer right? Please check. Is the answer right? Divya, please check. Is the answer right? Total 1,12,655. Very good. So this is my third answer. Total I need 4 answers. Now go to diagram 2. This was my diagram number 2. Do you have this diagram in the notebook? Open the mine after 1 year. Now suppose we have abandonment option also. Suppose we have abandonment option also. Look at the diagram and tell me which is the abandonment point. Which is the abandonment point? Which is the abandonment point? Can you mark the abandonment point? That is, if you continue beyond that, there is certainly going to be loss. This point, you are right. One student said 4,500. Write down 4,500 is abandonment point. Why? Because if I continue after this, I may get 5,000 with 0.5 probability or 4,000 with 0.5 probability. So my expected price will be 5,000 rupees, 4,500 rupees. Because if I am standing here and looking forward, I find there are only 2 possibilities, not beyond this, either 5,000 or 4,000 with 0.5. So I think my expected price is 4,500, and if it is less than the cost of extraction, it is better to abandon at that point. Is it right? It is better to abandon at that point. So write down in the diagram number 2, go to 4,500, tick mark, and write below abandonment point. That is the point we'll abandon. And now we'll do the same calculation. This cash flow will not change. Up to year 3 will not change. But in year 4, only we'll get these numbers. These 2 will be avoided. Probabilities will not change. Probabilities will remain 0.125 only. Probabilities will remain 0.125 only. So there are 2 ways you can compute the expected cash flow of the 4th year, like method 1 I have told you, or method 2, where you will take your cash flow after tax without abandonment option plus loss avoided. One more chance to you. What will be expected cash flow of 4th year with abandonment option? Please try. This time you can get it. Come on, you will try. Expected cash flow of the 4th year with abandonment option. Your previous answer was 9 lakh. It should be more than 9 lakh. It should be more than 9 lakh, not less than 9 lakh. 9 lakh plus something. 9 lakh plus something. Okay, try again. Try again. Anybody wants to answer what will be expected cash flow of the last year with abandonment option? Expected cash flow of the last year with abandonment option. First we'll give you a note. Later on you'll forget. So write down the note first. The mine will be abandoned. The mine will be abandoned if the price of the gold. The mine will be abandoned if the price of the gold in year 3 goes down to rupees 4,500. Price of the gold in year 3 goes down to rupees 4,500 because the expected price of gold from this level in the next year will be rupees 4,500, which is less than extraction cost, okay, which is less than the extraction cost. Now write down calculation of NPV. Draw the table. First write down year, particulars, cash flow, discounting factor at 10%, discounted cash flow. Year 1, cost of opening the mine 10 lakh. Year 2, CFAT 9 lakh, 3 9 lakh, 4 working note below. For 4 we'll prepare a working note. Write down working note, calculation of cash flow of year 4. Calculation of cash flow of year 4. First write down CFAT without abandonment option. CFAT without abandonment option. CFAT without abandonment option is 9 lakh. Calculated earlier. If you go to your situation 2 without abandonment, you will find 9 lakh rupees there. Then write down add back loss avoided. Probability of getting 4,500 is 0.25. This is probability of getting 4,500. This is your expected price. This is your extraction cost, and this is your quantity. So what is the answer now? The answer is 25,000. Therefore CFAT with abandonment option 9,25,000. CFAT with abandonment option 9,25,000. CFAT with abandonment option 9,25,000. Right. I am going to solve by one more way. Write down alternatively. You can solve by this also. You will get the same answer. Go to the last year. Diagram 2 last year. First six number. Each of them has a probability of 0.125. 0.125 into bracket. First number on the top right side, in diagram 2, 7,000 minus 4,600, that is extraction cost, plus 6,000 minus 4,600 extraction cost, plus again 6,000 minus 4,600 extraction cost, plus 5,000 minus 4,600 plus 6,000 minus 4,600 plus 5,000 minus 4,600, bracket close, into 1000 quantity. We are not writing the last two numbers. The last two number we will not write because we are not going to go up to that point. We are going to abandon the project. We are not going to get the last two numbers. And now if you solve it, you will get 9,25,000. Whichever method you are convinced, you think you can do it faster, you can do it in the exam, both are okay. 9,25,000. One student had replied 2,25,000. 2,25,000 is not right. I don't know how did you reach 2,25,000. You could have said 25,000 additional benefit. Okay, so 9 lakh plus 25,000 additional advantage due to abandonment. Any query on this? Now we'll go back to main page. Right here 9,25,000. Go to main page, write down 9,25,000 and please solve. Compute the NPV. 11,42,605. 11,42,605. But the probability of getting this is 0.5. Oh my God, that also you have to keep in mind. We are evaluating whether to postpone the project for 1 year. If we postpone the project for 1 year, there are two possibilities: 5500 with 0.5 probability, 4500 with 0.5 probability. This calculation is done for 5500 with 0.5 probability. For 4500, I am going to abandon then only. I am not going to start only. So write down below as the probability. Very good question. I hope you have realized by now. As the probability of price rising, to rupees 5,500 is 0.5, the expected NPV will be rupees 11,42,605 into 0.5 571,303. So this is my expected NPV. And then the question is, what is the value of abandonment option? Write down below that value of abandonment option. Value of abandonment option will be new NPV minus old NPV. New NPV minus old NPV. New NPV with abandonment option 571,303 on the screen in front of you. Old NPV, go to situation 2 answer. Old NPV, go to situation 2 answer 562,765. 562,765. Therefore, the answer is, please confirm, 8528. Anybody who got the same answer? 8528. 8528. 8538 sorry 8538. Is it right? Please just confirm, is it right? Okay. Now write down decision. What is the decision? Should you open the mine now with abandonment option, or should you open the mine after 1 year with abandonment option? What is your answer? With abandonment option, NPV in situation 1 was 1 lakh something. With abandonment option, NPV in situation 2 is 5 lakh something. So what is your decision? Even with abandonment option, the expected NPV is higher if mine is opened after 1 year. Hence, open the mine after 1 year. If price is rupees 5500, hence open the mine after 1 year if the price is rupees 5500. If the price is rupees 5500. So you have to conclude with the decision. Would your answer change if there is an abandonment option? In this problem, my answer still remains the same even if there is an abandonment option, because expected NPV is higher even with abandonment option in case 2 only. Now from my side, the answer is over. Question number 79. Mr. Chandar Sekhar owns a small piece of unused zinc mine. Instead of gold, this time it is zinc. That will cost rupees 1 lakh to start again. Instead of 10 lakh, they have given 1 lakh. If he opens the mine, he expects to be able to extract 1000 kgs of zinc a year for 3 years. After that, deposit will be exhausted. The price, this should be price of zinc is 500 rupees per kg. Instead of 5000, they have made it 500, and each year the chance is that price is likely to rise or fall by 50 is equally likely. Cost of extraction is 460. Oh my god, same to same question divided by 10. Each number divided by 10. Assuming discount rate is 10%. Hurdle rate means discount rate. Whether Shekhar should open the mine now or postpone the decision after 1 year in the hope of rise in the price of zinc. Homework. This you will solve it like the first part. This time there is no abandonment option. You please solve it like first part. Okay. Keep 2 pages blank in your notebook. Institute can simplify the question by not asking you the abandonment option. Keep 2 pages blank. Write there question number 79 homework. Must do. Without reading the any booklet answer or our answer, you try on your own and see if you have understood. If you can get it right, it means you have done it properly. So that was question number 79 for you, homework, which is exactly like 78 part 1. Answer is printed there for your help. If you need the help, you can refer the answer. This question is taken from June 2009 RTP, November 11 RTP. We have tried to bring all questions by institute, all question of the institute. Trust me, from the beginning of the institute till date, at one place, arranged chapter wise, topic wise, concept wise. Okay. Question number 80. It took almost 1 hour 10 minutes today to solve that answer. And yesterday also 5 minutes in drawing. So 1 hour 15 minutes was spent on this gold mine question. Only with practice you can do it much faster in the exam. In the class I had to give lot of explanation, so it took a lot of time, but once you have practiced it, you can do it faster. So today you practice gold mine question also independently on your own, right? Question number 80 from RTP. Question number 80, again write down important question, very important question taken from RTP. Question is, oil has been found in Bombay High region. Oil has been found. Very practical question. Indian Oil Corporation owns a lease to extract crude oil and is considering the construction of a deep sea oil rig. Construction cost is 20 crore. This is the first thing you have to keep in mind. Construction cost is 20 crore and these costs are expected to grow at a rate 10% per year. This is new. Year 0 it will cost you 20 crore, but if you construct in year 1 it will increase by 10%, so it will become 22. The risk-free rate is also 10%. Risk-free rate is also 10%. So the cost of oil well is constant at 20 crore. This means that if I compute the present value, it will come back to 20 crore because cost will increase by 1.10, but when you discount it by the same factor, you are going to get the same amount. So that is the meaning of this line. If you construct it after 1 year, your cost will be 22 crore. In present value terms, it will be 20 crore. The current price of oil is 200 rupees per barrel. The current price of the oil is 200 rupees per barrel. This barrel is the unit of oil. Internationally, they calculate in terms of barrel. Once a well is set up, the corporation's variable production cost to extract and refine the crude oil is 80 rupees. 20 crore is the cost, discount rate is 10%, selling price is 200, variable cost 80. These are the important numbers. Now it says, assuming that there is no maintenance or other fixed cost, the well is expected to produce 2 lakh barrel per year in perpetuity. The barrel is expected to produce 2 lakh barrel in perpetuity. Again underline, this is the quantity you are going to produce. This is the quantity you are going to produce, 2 lakh barrel per year in perpetuity. All cash flows are, perpetuity means forever. In this question, the life of the project is infinite. Life of the project is infinite, means you are going to get this cash flow forever. You are going to get this cash flow forever. All cash flows are assumed to occur at the end of the year. Production is expected to start immediately, in which case first cash flow will occur at the end of the first year. That is okay. Construction will be incurred today, revenue will start from the end of the year. Then what is the problem? Up to this it was very easy. The problem is this next paragraph. Pay attention. Everybody please pay attention. Currently, OPEC countries, OPEC means Organization of Petroleum Exporting Countries. Organization of Petroleum Exporting Countries. It's a cartel of oil producing companies are deliberating oil output and prices. Deliberating means they are negotiating, discussing. There is a meeting going on between these OPEC countries. If OPEC members take unanimous decision, production will be limited. So they may decide to cut down the production. And if they decide to cut down the production, the oil price will rise to 300 per barrel in perpetuity. If the OPEC members cut down the production, oil price will rise to 300 rupees per barrel in perpetuity. If the cartel breaks up means they don't agree. Production and oil price production will rise. Price will fall to rupees 100 per barrel in perpetuity. Price will fall to 100 rupees per barrel in perpetuity. This negotiation will be settled within 1 year. So when will you come to know whether price will rise to 300 or fall to 100? After 1 year. After 1 year, the decision of the cartel will be known. Once the new price is established, it is expected to remain at that level, either 300 or 100 rupees per barrel. Once the cartel decides to raise the price to 300 or reduce the price to 100, it will remain at that level forever, in perpetuity. The corporation estimates that, corporation means Indian Oil Corporation, estimates that oil price rise and oil price fall are equally probable. Equally probable means the probability of getting 300 is 0.5 and the probability of getting 100 is 0.5. You are required to advise the corporation whether to invest immediately. Same problem like gold mine problem, whether to invest immediately or wait for 1 year. If you invest immediately, your calculation will be based on current price of the gold oil, 200 rupees. But if you wait for 1 year, then you will first calculate assuming cartel succeeds and price is 300. Then you will calculate for 100 assuming cartel fails and the price is 100, and then you will compute the expected cash flow. Then you will compute the expected cash flow and take the present value. Is it right? So in second case, for every possibility, you have to compute the NPV and take expected NPV. You are also advised to calculate the value of the option to invest in 1 year period and suggest accordingly. Find out the value of the postponement option. Find out the value of the postponement option. That is the question. Value of the postponement option is NPV with postponement option and minus NPV without postponement option. So how do I solve? Right. Calculation of NPV. If oil rig is constructed now, that is very easy. If oil rig is constructed now, you will incur cost today, you will get the revenue forever. So it's an infinite life problem. Very rarely they ask, but it is an infinite life problem. Please solve. Calculation of NPV. Year, particulars, cash flow, discounting factor at 10% and discounted cash flow. Okay, year 0. Year 0, cost of oil rig. Cost of oil rig. How much is written? 20 crores. 20 crores. Rupees in crores. Rupees in crores, write down top right hand side. Then year 1 to infinity. 1 to infinity. Because perpetuity, you are going to get cash flow equal to 2 lakh barrels, 2 lakh barrels quantity, selling price minus variable cost, contribution 120, contribution 120. So my cash flow will be 2.4, cash flow will be 2.4 crores. My question is, what is the present value of this? Yes, please reply. What is the present value of this? Your cost of production is 80, selling price is 200, total quantity is 2 lakh. So my total cash flow would be 2.4. One student is asking, please repeat. What should I repeat? I don't know. From where should I repeat? Can you just elaborate? Can you please elaborate? My question is, what is the present value here? One student has replied 24. You are right. Write down working note for this. Working note for this. PV of NVT is A upon R. PV of NVT is A upon R. 2.4 divided by 10%, 24. Directly write 24 here. No need to write factor. No need to write factor. Is it right? Because it is an NVT. And now you tell me the total. Total is 4. Total is 4. Full question cannot be repeated. You can watch it later. Is it right? Total is 4. There is no time to repeat full question. You can just go backward and you can revise. Okay. There are other hundreds of students also who are learning simultaneously. Now write down point number B. Postpone the construction of oil rig for 1 year. Postpone the construction of oil rig for 1 year. Postpone the construction of oil rig for 1 year. Under that write down situation 1. Price goes to rupees 300. Price goes to rupees 300. Price goes to rupees 300. We'll do one by one. Because after 1 year, listen to me, after 1 year I will get to know whether the price is 300 or whether the price is 100. Because that is the advantage of waiting. It will be either 300 or 100. If it is 100, what will be my NPV? If it is 100, if it is 300, what is my NPV? If it is 100, what is my NPV? So let us write one by one. Some students, what they do, they take 300 into 0.5, 100 into 0.5. That is not right. You have to take one by one. Why are you waiting? You are waiting so that you will know what is the price after 1 year. Format is same. Format is same. But this time the cost of oil rig will increase by 10%. It will become 22. Read the instruction in the problem. The cost of oil rig will increase by 10% per year. Cost of oil rig will increase by 10% per year. Present value factor for year 1, 0.9091. 0.9091, and present value you should get same amount. You are multiplying 20 by 1.10 and again dividing by 1.10. You should get same answer. and once you construct the oil rig, the cash flow will start from next year, second year till infinity. Second year till infinity. Cash flow will be 2 lakh units into 300 minus 80. 2 lakh units into 300 minus 80. Rupees in crore. Rupees in crore. Please reply. 4.4. Rupees in crore 4.4. Okay, now I am going to ask you a question. Same question. Please reply. Let me understand you are understanding something or not. For last 10 days we are learning this chapter. Can you find present value? One student is saying 4.4 divided by 10%, 44. 44 is not right. Come on, try again. 44 is not right. 44 is not the final answer. It is incomplete answer. 44 is not final. I know somebody will say 44. You are here in year 2 and you are getting cash flow 4.4. If you apply the formula, you will get PV at the end of year 1. So PV1 is 44. PV0 will be how much? PV1 is 44, I understand. PV0 will be how much? 44 divided by 1.10. Now you are right. Now you are right. So the answer is 40. You have to further divide by 1.10. Write down working below. Working note. Working note for present value 4.40 divided by 0.10 into 1 by 1.10. This will give you PV1. By multiplying by this factor, this is PV0. Some students write 44, which somebody has done in the class today, and that is where the institute's NPV increases. Your NPV decreases, ICI's NPV increases. Okay, you are responsible for making the institute the most richest accounting body. So what is your NPV now? 20. But that is not the end of the answer. This is if the price rises to 300. Okay. Now write down below situation 2. Situation 2. When price goes to rupees 100 per barrel. When price goes to rupees 100 per barrel. When price goes to rupees 100 per barrel. Same format. Year, particulars, cash flow, discounting factor, DCF. Now you can do it yourself also. Same calculation, only number will change. Year 1, write down same figure. Year 1 same figure, 2 to infinity. This will change because now my price is 100 rupees. If the OPEC countries, they don't agree on production cut, everybody will start increasing the production, supply will increase, price will fall to 100. That is the advantage of waiting for a year. You will get to know where do you stand. So this is 0.4 crore. Quickly reply now. Now don't take time. What is the answer in the last column? First you divide 0.4 by 10%, then divide by 1.10, then divide by 1.10. 3.64 is the answer. Refer working note below and write here working note. First you take 0.4, divide by 10%, you will get PV1. multiply by PV factor, you will get PV0. You will get PV0. So please tell me the total. 16.36 negative. 16.36 negative. When price was 300, NPV was 220. When price is 100, NPV is 16.36. The probability is 0.5. Okay. Now you are one of the brilliant students of this country. You have reached CA final is a big proof of that. Now today I am asking you a question. What is the expected NPV if you wait for a year? What is the expected NPV if you wait for a year? What is the expected NPV if you wait for a year? What is the expected NPV if you wait for a year? Any answer? Any answer, please? One student is saying 1.82. One student is saying 1.82. Other answer? Anybody else who wants to contribute to this wonderful discussion? 1.82. First tell me, okay, after 1 year, the price is 300 or 100, NPV will be positive here, NPV will be negative here. After getting negative NPV, would you still dare to start the project? After knowing that if I start the project, I'll get a negative NPV, would you still start the project? Would you still start the project? The answer is no. This calculation only indicates that if the price is 100, NPV is negative. If NPV is negative, I am not going to start the project. Not start the project. And if I don't start the project, my NPV is 0. This is only calculation. But my decision will be I will not start the project if the price goes down to 100 rupees. Like in the previous question of gold mine, if the price goes down to 4,500, I will not start only. But in that question, the price was below 4600, so you could easily understand. Here also, it is similar situation. I am getting negative NPV, I will not start. Therefore, I will take 0 NPV if the price goes down to 100. So write down below, that was the important point. Many students make the same mistake. They write 1.82 and then the institute's NPV goes up. Okay. If the price of the oil goes down to rupees 100, pay attention, goes down to rupees 100, the oil rig should not be constructed. The oil rig should not be constructed. The oil rig should not be constructed. Thus the NP will be 0. Thus the NP will be 0. Now write down below expected NPV of the postponement decision. Expected NPV of the postponement decision is equal to 0.5 into 20 plus 0.5 into 0, 10. 0.5 into 20 plus 0.5 into 0. Next line write down value of the option 10 minus 4 10 minus 4 6. And what is your decision? You will write decision, what is the decision you will write? Should we invest now or wait for 1 year? Invest now or wait for 1 year? Invest now or wait for 1 year? Invest after 1 year if oil price rises to rupees 300 per barrel. Barrel is the unit in which they measure oil. We measure in liter, petrol 5 liter, 2 liter, 1 liter. So it is measured in barrel. Okay, so that was one very good question from your RTP. I hope you have written it, very important question. These two questions 78 and 81, sorry 78 and 80, two very important questions from this area, postponement. Now we'll take some easy question, one easy question for you. After two brainstorming problems, we'll take one easy question. Relax. A firm is evaluating a project. A firm is evaluating a project. Initial investment amount is rupees 600 lakhs. Cost of the capital is 10%. Cost of the capital is 10% for discounting purpose. If you invest today, 600 lakhs will be required. It is a perpetual project. Oh my God, once more perpetual project. Same formula you will apply, A upon R for present value, where annual cash flow depend upon the level of demand as shown below. So annual cash flow depends on demand. If it is high, 170, probability 0.5, medium 80, probability 0.3, low, why law? Law is deleted now. Low 20.2. In 1 year time, level of demand would be known with certainty. In 1 year time, the level of demand will known with certainty means if you wait for 1 year, you will get to know whether the demand is high, medium or low. High, medium or low. You will get to know after 1 year if you wait for 1 year. So instead of starting the project today, the firm will wait for 1 year and then decide. If it decides to start the project after 1 year, initial investment would be rupees 700 lakhs. But the cost of project will increase to 700 lakh if you start after 1 year. If you start after 1 year, it will be 700 lakh. If you start today, it will be 600 lakhs. If you start today, then you have to basically deal with expected cash flow of the next year. But if you wait for 1 year, then you will do 3 calculation, because by the time 1 year is over, you will know the demand position, either this or this or this, not all 3 now, and therefore we'll do separate calculation in all 3 scenario. Like oil problem, price can be 300, price can be 100. Now here the demand can be high, what is NPV? Demand can be medium, what is NPV? Demand will be low, what is NPV? If you are getting negative answer, make it 0. If you are getting positive answer, keep it as it is, and then compute the expected NPV if you wait for 1 year. Select that option which has higher NPV. If start now gives you higher NPV, start now. If waiting for 1 year gives you higher expected NPV, wait for 1 year? That is the question. Start now or wait for 1 year? So what we will do? We will solve. First you will solve part 1, alternative 1. Learned student will solve. You are very intelligent, I know, but you are not putting that much effort. Alternative 1, start the project, put more effort. Current effort is not enough. Expected annual cash flow I will compute first. Expected annual cash flow, draw 4 columns: demand, probability, cash flow, expected cash flow. Is it right? Solve yourself. Please solve yourself. Put lot of efforts. Give me the final answer. Give me the final answer. Total of the last column will be final answer. Total of the last column will be final answer. Anybody, what is my expected annual cash flow if I start now? Total of the last column. Come on, students, come on. One student finally replied. 113. Wonderful. Amazing. So 113 is right. 113 is right. And this is perpetuity. Per annum forever. 113. Sajid Khan is also right. After many days you have replied. Very good. At least replied. Be positive. PV of cash inflow. PV of cash inflow. Write down step 2, expected NPV. Very simple, ordinary question. Step number 2, expected NPV in right hand side, rupees. I don't know whether it is rupees in lakhs or crore. Lakhs. Write down rupees in lakhs. Rupees in lakhs write down. First point A, PV of cash inflow. PV of cash inflow will be 113 divided by 10%, A upon R for perpetuity. Answer is 1130. Answer is 1130. Now write down less initial investment. Less initial investment 600. If you start now, the initial investment is 600. If you start now, the initial investment is 600. Therefore, NPV 530. Therefore, NPV is 530. Therefore, NPV is 530. Therefore, NPV is 530. Now write down alternative 2. What is alternative 2? Wait for 1 year. Wait for 1 year. If I wait for 1 year, what is the advantage? I will get to know the demand position. I will get to know whether the demand is high, medium or low. Okay. And I will do calculation of NPV separately for each demand situation. Write down scenario 1. High demand at year 1. High demand at the end of year 1. We find that the demand for the product is going to be high. If the demand is going to be high, my NPV will be equal to annual cash flow 170 per annum divided by 10% will give you PV of perpetuity minus investment will be 700. Investment will be 700. So 700. Investment will be 700. So write down answer is 1000. Answer is 1000 means the NPV is positive. Option will be exercised. Option to postpone will be exercised. Option to postpone will be exercised if you want to write, otherwise not required. Option will be exercised. just to keep in mind, if you get negative NPV, you will not exercise the option and the value of the option will become 0. Now write down scenario 2, medium demand at year 1. Medium demand at year 1, same format, NPV equal to, you will get 80 divided by 10% minus 700. Yes, answer please. Anybody answer? You can do without calculator. 100 is right. Will the option be exercised? Yes, option will be exercised. We are going to start the project. Option will be exercised because we are getting positive NPV. Now write down scenario 3. Low demand at year 1. Low demand at year 1. If demand is low, my cash flow is 20 divided by 10% minus 700 is equal to 500 negative. Will the option be exercised here? You will write option will not be exercised. I will not start the project. Therefore, NPV is equal to 0. Therefore, NPV is equal to 0. This was important. Some student will take minus 500 also and compute the expected NPV. That is wrong, and then you lose the full marks. So minus 500 is correct calculation, but because you have a choice to start or not to start the project, why would I start the project knowingly that my NPV is negative? So NPV is 0. So I have got 3 NPVs now. One was 1000, one was 100, and one is 0. So my expected NPV after 1 year, because these 3 calculations we have done after 1 year. So expected NPV after 1 year, it will require discounting. It will require some discounting. So please first give me this answer. What is my expected NPV after year 1? 530 is right. 530. This is after year 1. This is after year 1. Remember oil rig problem, you have to discount it again. Okay. Hence expected NPV today. Hence expected NPV today. Hence expected NPV today, that is year 0. Hence expected NPV today, that is year 0. Solve. Your answer is 530 divided by 1.10, and that is equal to 481.82. 481.82. Now compare this answer with the earlier answer. The earlier answer was, I think, 530. The earlier answer was 530 and now it is 481.82. Please answer what is preferred. Start now or wait for 1 year. Start now will give you 530. Wait for 1 year, 581.82. So the answer, write down, the project should be started now. The project should be started now. The project should be started now because expected NPV is higher. Because expected NPV is higher. Because expected NPV is higher. So that was an easy question. But if they ask you question of postponement, and on postponement you have 2 or 3 possibilities, then you first compute NPV of each possibility separately. The one which is negative, you will say option will not be exercised, its value is 0. The ones which are positive, you will take those values, multiply by probabilities, and don't forget to discount again by 1 year factor or 2 year factor if the postponement can be done for 2 years. Okay, so that is how you will solve this type of simple questions. 3 problems we have solved today on postponement. the question on gold mine, the question of oil corporation, and now this easy question. Question number 82. One more question from the institute. In May 2013 exam for 5 marks. Mark it, very important. This is an exam question. On the screen, May 13 exam 5 marks. Compulsory question 5 marks. Because you know, first earlier the format was first 20 mark question was compulsory. So it was one of those questions. Question is, Ramesh owns a plot of land on which he intends to construct apartment units for sale. So you have a land, you want to construct apartments and you will sell the apartments. Number of apartment units to be constructed may be either 10 or 15. So you can construct 10 apartments on the land, or you can even construct 15 apartments. The total construction cost of this alternative are estimated to be 600 lakhs and 1025 lakhs respectively. So if you construct 10 apartments, cost will be 600. If you construct 15 apartments, cost will be 1025. So accordingly you have to do the calculation. So you have two options to start, either 10 or 15. Okay, then you will see what is the profit in 10, what is the profit in 15, and the one which gives me more profit, I will decide to construct those number of apartments. First line is clear. Current market price of each apartment unit is 80 lakhs. The market price after a year for apartments will depend on the conditions of the market. There is one more possibility. You can wait for a year, okay, and the market price after 1 year will depend on the conditions of the market. If the market is buoyant, what is buoyant? That is, if the market is, there is a large demand, huge demand, okay, people are searching for new apartments, demand is more than supply, each apartment will be sold for 91 lakhs. But if the demand is sluggish, the price will be 75 lakh. Each apartment can be sold for 75 lakh. So the advantage of waiting is that you will get to know whether you will get 91 lakh or 75 lakh. The question is, first determine the current value of the vacant plot of land. Second, one more information they have given. The yearly rental per apartment is rupees 7 lakh. Should Ramesh start construction now or keep the land vacant? Should he start construction now or keep the land vacant? That means construct after 1 year. And to compute present value wherever required, the risk-free rate is 10% per annum. Now in this question, one important thing is missing. Market can be buoyant, spelling B-U-O. Market can be sluggish. You will get 91 lakh or 75 lakh. But what about the probability? What about the probability? The probabilities are not given. The probabilities are not given. Don't worry. We have studied option valuation model. One of the option valuation models we have studied was risk neutral model. And in that risk neutral model, we have learned how to calculate the probability of price rise or price fall using that same knowledge of probability learnt in risk neutral model, in option valuation model, we are going to calculate the probabilities. So this institute has mixed two chapters. One, the derivative option valuation model, where we learn the probabilities of rise and fall, and this chapter where we have to learn to take decisions whether to construct now or after 1 year. So very good question, because you will have to also apply risk neutral model to get the probabilities. Is it right? So write down the answer please, and I will explain again and again while writing the answer. Everybody is ready? First write down alternative 1. Alternative 1, write down start construction now. Start construction now. Under that write down, and again we have two choices here. Now also we have two choices. So there are broadly two choice, now or later. Under now also we have two choice, 10 flats, 15 flats. Later also we have two choices, 10 flats, 15 flats. So I have to write total 6 answer first and compute the profitability. So start with 10 apartments now. Case 1, 10 apartment units. And what will be your profitability? You are going to sell 10 apartments for 80 lakh, and for the construction cost of 10 apartments, the cost is 600 lakh. The answer is 200 lakh will be your NPV, because you will construct now, sell now. Construct now, sell now. Where is the discounting required? Only assumption is construction will be completed today, sale will also be done today itself. No time lag. Okay. Of course, practically you can't construct in one day, but that you can ignore for the time being. Now write down case 2, 15 apartments. Suppose I want to construct and sell 15 apartment units. What will be my NPV or profit? So 15 into 80, selling price per apartment is same, but the construction cost will not change proportionately. They have given you, if you construct 15 apartments, then the cost will be 1025. You will say, sir, it is not matching, 600, it should be 900. Don't bother, what they have given is right, because construction cost may increase if the number of floors go up. It doesn't change in the same proportion. So this time the answer is 175 lakh. So in case if you want to construct now, you have to lock numbers one by one. If I want to construct now, I will construct 10 units, because my NPV is 200 lakh, which is more than 175 lakh. Write down note. If we construct now, we will construct 10 units. We will construct 10 units at NPV is equal to 200 lakh rupees. At NPV equal to rupees 200 lakh. At NPV equal to rupees 200 lakhs. So if we construct now, my NPV is 200 lakh. Okay, so that one figure is locked. Alternative 2, write down, wait for 1 year. Wait for 1 year and keep the land vacant. Wait for 1 year and keep the land vacant. So this is like a call option. This is a call option which you can exercise after 1 year if the price rises. Okay. So this is like a call option. Write down, this is like a call option, or this is a call option. And after you wait for 1 year, there are two scenarios. One is buoyant market, sluggish market. Okay, if the market is buoyant, the flats can be sold for 91 lakhs. So write down scenario 1, buoyant market, in bracket, price is equal to 91 lakhs per unit. Price is 91 lakh per unit. And here also we have two choices. Here also we have two choices. We can construct 10 units or 15 units. Case 1, 10 units. Case 1, 10 units. If I construct 10 units, my NPV after 1 year, I need to discount it, don't forget. NPV after 1 year will be 10 into 91 minus 600. 10 into 91 minus 600, 310. And you can have another case too, 15 units. You can have 15 units also. You can construct and sell 15 units also. Then NPV after 1 year will be 15 units into 91. 15 units into 91 minus 1025. Answer 340. Is the answer 340? Is the answer 340? Please confirm. Please confirm 340 is right. Some student is saying 310. I don't know how 310 has come. 340 is right. 340 is right. Okay, 340 is right. 310 was not right. So I have to make a choice between 10 units and 15 units. I have to make a choice between 10 units and 15 units. So what will be my value of this call option? For waiting for 1 year, if the market is buoyant, I will choose higher of the two. So write down value of the call option will be higher of the two, 340. Value of the option will become 340. I will take higher of the two. So if the market is buoyant, we will construct 15 units and my NPV after 1 year will be 340. Log this number. If market is buoyant after 1 year, my NP will be 340. One more thing I will try. Scenario 2. Scenario 2, write down sluggish market. You wait for a year. You wait for a year and you find that the market is sluggish. If the market is sluggish, you can sell per flat at rupees 75 lakhs per unit. Price is 75 lakhs per unit. So what will be my NPV? There are two options here. One is 10 unit, one is 15 units. Again write down case 1, 10 units. If you construct and sell 10 units after 1 year, what will be your NPV? 10 into 75 minus 600. 150. That was easy. Right below case 2, 15 units. Case 2, 15 units. 150 is right. Very good, Pathan. 150 is right. Case 2, 15 units. NP will be 15 into 75. 15 units into 75 lakh per unit. But the construction cost of 15 units is 1025. 1025. I think it is 100 now. Just check. $100 is right. So what is my answer for sluggish market? What is my answer for sluggish market? Value of call option will be higher of 150, 100. 150, 100 is 150. 150. So if the market is buoyant, the NPV is equal to 340. If the market is sluggish, the NPV is 150. But the problem is, what is the probability? They should have given probability and my life would have been easier. but this is the exam. Okay, you have to really learn a lot of varieties of question. You can blame me for taking so many questions. Earlier it was a positive feedback, now it is a negative thing. Teacher is teaching so much. Oh my God, we are putting all our efforts, energy for you, and then the student says, why teach so much? Other teacher will teach 150 hour and the SFM is over or AFM is over. Then will you do this question there? That is the question mark. And if this asked in the exam, and if you have not prepared, even in best of the students in the exam condition, if it is a new problem for him, he cannot visualize that he has to apply a risk neutral model here to get the probability. Okay, right. In this question, so please be serious and practice every day. We are working for you only. In this question, probability of buoyant and sluggish market. In this question, the probability of buoyant and sluggish market is not given. We have to find the probability using risk neutral model. Using the risk neutral model. Okay. So first I am going to explain how do we compute probability in risk neutral model. Today the price is 80 rupees. Write down S equal to 80. Today the price is 80 rupees. Like in risk neutral model, we used to write share price. It will rise, it will fall. Depending upon rise in the price, the value of call option is decided. Depending upon the fall in the price, the value of call is decided. So share price today, or you can say flat price today is 80, and after 1 year it will be 91. And the rent for 1 year is given in the question. Somewhere in the problem they had given yearly rent per apartment is 7 lakh. That is like dividend. That is like dividend in binomial model. That is like dividend in the binomial model. So you are going to get 91 plus 7 rupee or 7 lakh rupees rental also. So my total value will be 98, sale price plus rent, and we need to find this probability. Whenever rent is given, we will add it to the sale price after 1 year, similar to getting dividend on the stock after 1 year. Now next is, if the market is, you can write here buoyant and sluggish if you want. 75 plus rent 82. Just for understanding, write a note why we are adding 7. Rent is like dividend in the binomial model. Rent is like dividend in the binomial model. So can we now compute the probabilities? Remember risk neutral model. Can we compute the probabilities? Write down probability equal to probability of rise. P here stands for probability of rise in the price. R minus D upon U minus D. R minus D upon U minus D. What is R here? R here means 80 rupees today. If invested for 1 year at 10%, what will be its value? 80 into 1.10. 80 rupees today invested for 1 year at 10%. 80 into 1.10. What is D? D means the value if the price goes down. The value if the price goes down. This is 82. That is D. And U means the value if the price goes up. That is 98. So if you don't remember, I am just explaining. More detail will be explained in risk neutral model, and how to derive this formula, it is explained there. So 0.375, Divya is right. 0.375, wonderful answer. I appreciate your effort. 1 minus P will be equal to 0.625. Anup is also right. These are the probabilities. If you have done risk neutral model, cakewalk. Otherwise, for the time being, write it down. Later on, whenever you will study risk neutral model, you will find this is the formula to compute the probability. Now we are ready with probabilities. We have got the value of call option when the price will rise 340, when the price will fall, it was how much, 150 or something. So just multiply these probabilities and those values, you will get the expected NPV. So again draw the diagram for understanding if you want. Sajid is also right, probability 0.375, very good. Now draw the value of call option today, or value of call option will be 0.375 probability 340, 0.625 150. Oh, so can I now find the expected NPV after 1 year? Can I find expected NPV after 1 year? Say yes or no. Can I find expected NPV after 1 year? Yes. By multiplying 340 into 0.375 plus 150 into 0.625, that will give me after 1 year expected NPV. Divide by 1.10. If I divide by 1.10, I will get present value today, which I can compare with the first answer, construct now, and then take a decision. So write down please, after writing that diagram. Have you noted the diagram? Yes or no? Have you noted the diagram? Yes. So now write down value of call option today. Value of call option today, probability into value plus probability into value, and divide by 1.10, because this value you are getting is after 1 year, and dividing by 1.10 gives you value in year 0. Anybody answer for this? Please answer, then I will understand. Yes, you are also showing interest. Okay. Answer 201.14. Very good, amazing. 201.14. Everybody got it right. $201.14. Now write down, there was a question, what is the value of the plot of the land? So write down, thus the value of the vacant plot, is 201.14 lakhs. The value of the vacant plot is 201.14 lakhs. And then write down the decision. What was my original answer? My original answer was 200 lakh, and now it is 201.14 lakh. What would you prefer? Would you prefer 200 lakh or would you prefer 201.14 lakh? So 201.14 is right. Write down, the firm should keep the land vacant. The firm should keep the land vacant because the current value of the land, is more than profit from, because the current value of the land is more than profit from 10 units apartments now. Because the current value of the land is more than profit from 10 units apartments now. So profit from 10 units apartments now is 200, and the value of the waiting is 201.14 lakh. So it is better to wait for a year. That was the question of the exam May 2013 exam for 5 marks, but it is little time consuming question for 5 marks considering 5 mark weightage. Anyway, so that we have done. Now one more interesting question we will take from RTP May 2011. RTP May 2011. Write down again important question. Important question. If it is asked in the exam, if you are well prepared, you can easily do it. Otherwise, there is a possibility of mistake. I don't say you will make mistake. There is a possibility. TMC is a venture capital financer. It received a proposal for financing requiring an investment of rupees 45 crore. So investment is 45 crore, which returns 600 crore after 6 years if it succeeds. So today you make an investment of 45 crore, but if the project becomes successful, then you will get 600 crore after 6 years. That is how venture capitalists work. They take a risk, they take a big bet, and if the decision is correct, they make a huge return. 45 crores becoming 600 crore after 6 years, you can imagine such a huge return. However, it may be possible that the project may fail at any time during the 6 years. But the project can fail at any time during the next 6 years. What does that mean? It means that if the project has to be successful, it has to be successful in all the years. If the project has to be successful, it has to be successful in all the years. Then only finally you will be able to realize 600 crore. If it fails in between, the project will get over and you will not get anything. The following table provides the estimate of probability of failure of the projects. The following table provides the estimate of probability of the failure of the project. First year probability is 0.78, second year probability is 0.25 chance that it is fail, and same way they have given you probability of failure in the year 1, 2, 3, 4, 5. So if the project has to be successful, it has to succeed in all the years, which means I need to calculate the probability of success. I need to calculate the probability of success, which will be 0.72, 0.75, 0.78, 0.82, 0.82, 0.90. Now I am going to ask you a $1 million question. If you give correct answer, you will get $1 million check. Okay, immediately on the screen I will give you. What is the probability that the project will succeed? Simple question. What is the probability that the project will succeed? What is the probability that project will succeed? What is the probability that project will succeed? How do I solve? It has to succeed in all the years. It has to succeed in year 1 and year 2 and year 3 and year 4 and year 5 and year 6. If it succeeds in all the year, then it is a success. Therefore, you will have to multiply by all these probabilities. We will have to multiply by all these probabilities. All success probability you will multiply then you will get that the project is finally successful. So what is the probability of success? Come on, please reply. You just have to multiply. What is the probability of success? Very low probability, very right. 0.2548. 0.2548. So I'll give you one check of $1 million on the screen. $1 million check. Okay. State Bank. So this check goes to Divya. Now, what is the probability of failure? If the probability of success you said 0.2548, the probability of failure is balancing figure 1 minus 0.2548. That is whatever you get, that is your probability of failure. Probability of failure. Is it right? Now let us read the problem further. In the above table, probability that project fails in the second year is given that it has survived through year 1. Similarly for year 2 and so forth. TMC is considering an equity investment in the project. The beta of this type of project is 7, very high beta, 7. Market return and risk-free return are 8% and 6% respectively. So this will give you cost of equity for the purpose of discounting. You are required to compute expected NPV of the venture capital project and advise TMC. Advise TMC. So basically we have to compute NPV if project succeeds, NPV if project fails, and multiply by their respective probabilities. That is my expected NPV. And if the expected NPV is positive, I will accept the proposal. If the expected NPV is positive, I will accept the proposal. That is the answer. Very easy question if you know how to do it. Otherwise, you will find it difficult. Write down the answer in the notebook. Write down the answer in the notebook. You will get 600 crore only if the project finally succeeds, means success in all the years. Success in all the years. Joint success. Success of year 1 and 2 and 3 and 4 and 5 and 6. Reminds me of the CA course. Success in foundation plus success in inter and success in final, then you are CA. Is it right? I will not write probability of our exam. You will feel disheartened. Okay. You can try the same logic on CA course also and find the probability. So write down the answer. Probability that project succeeds. First year will be 1 minus 0.28 into second year 1 minus 0.25, third year 1 minus 0.78, fourth year 1 minus 0.82, fifth year 1 minus 0.82, last year 1 minus 0.90. So that is 2.255. Step 2. Therefore, probability that project fails, 1 minus 0.255, 0.745. Next working note is calculation of cost of equity using CAPM. Calculation of cost of equity using CAPM. Please reply. Cost of equity equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. 6 plus 7 into 8 minus 6. Very risky project. So beta is very high. Beta of 7 is abnormally very high, but in venture capital this is possible. So that is 20%. That is 20%. Is it right? Now I need to compute NPV if the project succeeds. Write down step 4. Step 4. Calculation of NPV if the project succeeds. Calculation of NPV if the project succeeds. Calculation of NPV if the project succeeds. 600 multiplied by PV annuity factor in bracket 20% comma 6 years minus initial investment 45. Minus initial investment 45. Reply now. What is the NPV? Final answer. Final answer please. Final answer only. Approximately 156. Is it right? Approximately 156. Final answer 156. Step number 5. Step number 5. NPV if the project fails. NPV if the project fails. NPV if the project fails. If the project fails, your initial investment would be a loss. You will not get anything. So my loss will be 45 crore. Loss is 45 crore and therefore expected NPV. Therefore expected NPV. You have computed probabilities. You have computed NPVs. Multiply the two. Just quickly reply. I want you to reply fast. Expected NPV will be 6.255 crore. 6.255 crore. This is how this venture capitalist take decision. It is positive. It is positive. So what do? I will write as NPV is positive. As NPV is positive, accept the proposal. As NPV is positive, accept the proposal. As NPV is positive, accept the proposal. So that was a very important question number 83. Any query now? Different types of question they are asking in the exam. Question number 84. We'll take a small break now for 10 minutes. And after the break, we are going to solve another RTP May 19 question. RTP May 19 question we are going to solve after the break. Okay, please come back. Question number 84. Question number 84. Are you ready now for this amazing question number 84? Currently, there exists an opportunity to invest rupees 1 lakh for manufacturing a product. 1 lakh is your investment required today. If you invest today, the estimated demand, sale price and variable cost will be 6,000, 6,000 quantity, 10 rupees per unit and variable cost 6 rupees per unit. So option 1 is now. Another option is if investment is deferred by 1 year, postpone for 1 year, the estimated demand, selling price and variable cost will be 8,000, 11 rupees, 5 rupees respectively. After 2 years, suppose you defer it for 2 years, you can defer it for 2 years also. Defer it for 2 years due to sluggish demand and import tariff on raw material. The estimated demand, selling price and variable cost will be 5,000 units, 9 rupees for selling price, 7.50 for variable cost respectively. Assuming cost of capital is 10%, that is your discount rate. Advise the best course of investment, amount to be shown to the nearest rupees. One thing which is not given in the problem clearly, what is the life of the project? What is the life of the project? So assumption write down, assumption write, project has infinite life. This assumption write down, project has infinite life. Project has infinite life. And then what I am going to do? I am going to do 3 calculations. I am going to do NPV calculation if we start now, NPV calculation if we start after 1 year, NPV if we start after 2 years, and select the option which will give me highest NPV. All NPV will be brought down to year 0. All NPV will be brought down to year 0 level. Is it right? So write down, very easy question, but you need to practice. Alternative 1, write down invest now. Invest now. If you invest now, NPV is equal to quantity into sale price minus variable cost that will give you annual contribution, divided by cost of capital. This will give you present value of perpetuity. This will give you present value of perpetuity minus investment. Minus investment is your initial investment. So solve for alternative 1. Question is in front of you. If you start manufacturing now, you can sell 6,000 quantity into bracket 10 rupees selling price minus 6 rupees variable cost. So that is your annual contribution divided by 10% cost of capital. This will give you PV of perpetuity minus 1 lakh. Answer please. Come on student, reply. You can do it directly without even calculator also. 6,000 into 4, 2,40,000, 24,000 divided by 10%, 2,40,000 minus 1 lakh. The answer is 1,40,000, not 78,182. 1 lakh you don't have to discount, it is already invested today. Is it right? Now write down option 2, invest after 1 year. Same formula, but one more thing I'll do. I will divide by 1.10 also the final answer, so that I get the present value today. Write down please. Invest after 1 year. Invest after 1 year. Write down NPV equal to NPV, just remove this one. NPV is equal to 8,000 unit, formula is same, into selling price 11 rupees minus variable cost 5 rupees, bracket close, divide by 10%, again bracket close. This will give me present value of perpetuity minus 1 lakh investment. The numerator will give me NPV at the end of year 1. Numerator will give me NPV at the end of year 1 discounted by 1 year factor. Discounted by 1 year factor. So what is the answer now? What is the answer now? Check the answer. Check the answer please. 345, 454. 345, 454. Now write down alternative 3, invest after 2 years. Invest after 2 years, same formula, but my NPV would be calculated by discounting by 2 year factor here. Question in front of you. Quantity to be sold 5,000 into bracket selling price 9, variable cost 7.50, bracket close. The whole thing you divide by 10%. That will give me PV of perpetuity minus 1 lakh investment, divide by 1.10 to the power 2. This is for present value calculation. This is for present value calculation today. Please reply. Don't feel shy. Reply. Yes, this is a good poem. Don't feel shy. Please reply. Don't feel shy. Please reply. Answer. Negative answer. 20661. Very good. 20661 is right. So now I have all the 3 answers with me. Choose the highest option. The highest option is if you defer the investment by 1 year. Write down decision. It is better to defer the investment by 1 year. It is better to defer the investment by 1 year and not by 2 years. And not by 2 years. It is better to defer the investment by 1 year, not by 2 years. Okay. So that was the answer from May 19 RTP in our book, question number 84. Now write down source of question number 85. Source reference book. Now in this problem we are going to merge capital budgeting problem with Black-Scholes model. This is real option. This is a question on real option. Real option means underlying is a physical asset, not a financial instrument. Very important question. First you write very important question, because now real option is also a part of your syllabus. XYZ company is a leading software company, is thinking of developing a new software project. Based on its experience, it can wait for maximum 5 years. That means you can start today or you can wait for 5 years. So this is like a call option with 5-year option expiry date. Real options have longer expiry date, 5 years. Before releasing the new product without experiencing any substantial loss of revenue. The present value of the expected future cash flow for the new product will be rupees 160 crore. The present value of the expected future cash flow will be 160 crore. That is treated like, in Black-Scholes model, it is treated like share price. While the investment to develop and market is 200 crore. This is like exercise price. This is like exercise price, investment amount. You if you want to undertake the project, then you have to pay 200 crore. Annual volatility of the logarithmic return of the future cash flow is estimated to be 30%. Standard deviation is 30% or 0.3. Standard deviation is 30% or 0.3. The continuous annual risk-free rate over the option's life of 5 years is 5%. So RF or R is 5% or 0.05. What is the value of the option to wait? So it is like finding the value of a call option. Finding the value of the call option, use Black-Scholes model to make your life easier. They have given you value of ND1. This is ND1. If it is 0.375, 0.646, and value of ND2, if it is minus 0.295, it is equal to 0.384. So one good thing they have done, they have given you the value of ND1 and ND2. With the help of this, you can easily solve this Black-Scholes model question in capital budgeting. So write down first in your notebook, write down, let us find the input parameters for Black-Scholes model. Let us find, please write down in the notebook. When you will write, you will learn more. Okay. Let us find the input parameters for Black-Scholes model. Now real option is also a part of your syllabus. So more questions like this can be expected. Let us find input parameters for Black-Scholes model. Then write down S equal to current asset value. S equal to current asset value is equal to 160 crore. Is equal to 160 crore. Then write down X equal to strike price is equal to investment is equal to rupees 200 crore. Then write down sigma, standard deviation is sigma, equal to volatility equal to 30%. R risk-free rate 5%. This you also write 0.3. This you also write 0.05. T write down time to expiration. Time to expiration 5 years. Time to expiration 5 years. We have to find the value of call option. C equal to price of call option, which is value of option to wait. Value of option to wait is call option. Option to abandon is put option. Option to abandon is put option. Have you noted this? Have you noted this? Yes or no? Once you have noted it down, please inform me. Very good. Now, do you remember Black-Scholes model? How many steps were involved? Anybody? In a non-dividend paying stock, how many steps are involved? Please reply. How many steps were involved in a non-dividend paying stock in Black-Scholes model? Do you remember? 4 steps, 5 steps, 6 or 7? 4, 5, 6 or 7? How many steps were involved? Some student is thinking, what is Black-Scholes model? Oh my God, that was a topic in derivative option valuation model. Step 1, write down. Step 1, natural log of S by E. First step is natural log of S by E. Natural log of S by E. Ln means natural log into bracket 160 by 200. Simplify first. Natural log 0.8. Natural log 0.8. Natural log 0.8. Is it right now? Now I will tell you a shortcut to calculate log value, but then it has to be common log. Then it has to be a common log. Solve. How do you solve common log? Common log means log with base 10. Common log means log with base 10. First you type 0.8 on your calculator. Press square root 12 times. Multiply by 1778.37, one constant number. This I have taught to you in derivative chapter. That gives me log value. Please check how much you are getting. Please check how much you are getting. Anybody, how much you are getting? Are you getting negative 0.09688? Please confirm. Okay. And log E means 2.78. E means 2.718. E means 2.718. Is it right? So you can type 2.718. Press square root 12 times. Press square root 12 times. Multiply by 1778.37. No, you are getting a different answer. What was the trick? I also forgot. Okay, you write down this number. These are the log values. Anybody who remembers? 0.8 square root 12 times, then minus 1, then multiply by 1778.37, minus 1 I forgot to write. Okay, let me check again. 0.8, press square root function 12 times. Okay, minus 1, then you multiplied by 1778.37. Okay, that's right. Thank you for reminding. Minus 1 was also there. And you try the same thing for this log E. Log E means 2.718. You will get this answer. So what is the final answer now? Please write it down. Minus 0.2231, minus 0.2231, minus 0.2231. Now we'll come to step 2, where we have to compute the value of D1. Where we have to compute the value of D1. D1 equal to ln S upon E, ln S upon E plus in bracket R plus sigma square by 2, sigma square by 2, sigma square by 2 into T upon sigma into under root T, upon sigma into under root T, upon sigma into under root T. Put the values, and solve. Put the values and solve. Let me see who gives me correct answer first. Let us see who will give correct answer first. Put the values. Anybody wants to answer? What is the value of D1? This is the only complicated calculation. After that, life will be easy. So the answer is, numerator is 0.2519, denominator is 0.67082, and check the final answer. Is it 0.375? Please confirm, is it 0.375? Is it 0.375? Okay, and that is why in the question the value of D1 0.375 was given. Okay, that was the reason, because D1 is coming to 0.375. Now step 3, write down D2 equal to D1 minus sigma into under root T. D1 minus sigma into under root T. Black-Scholes model we have done in your batch. Okay, those who have not done will please first read Black-Scholes model, then come to this question. Otherwise you will not get anything. 0.375 minus 0.3 into under root 5. Yes, answer now, little fast. Minus 0.295. Minus 0.295. Is it minus 0.295? That is why in the question also they have written ND2 minus 0.295 value. So good thing is that you don't have to refer normal table. Exactly the value that I want is given in the question. So please write down step number 4, ND1, 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 N into bracket 0.375, N into bracket 0.375, which is 0.646 given, no need to calculate, no need to refer table, given, same figure. Now write down step 5, step 5, ND2, ND2, under ND2 write N minus 0.295, N minus 0.295, which is given 0.384, which is given 0.384. If not given, you have to refer normal distribution table. Step number 6, e to the power minus RT, e to the power minus RT means present value factor. It is a present value factor, e to the power 0.05 into 5 years, e to the power minus 0.25, 0.25, 1 upon e to the power 0.25. Now you will solve. I have taught you how to get this also. Is it right? Anybody who would want to reply? Anybody wants to reply? Anybody wants to reply? One student has replied 1.2840. Very good. 1.2840, or you can say 0.7788. No problem. Factor is 0.7788. Present value factor will be 0.7788. Now the last step, step 7, value of call. Do you remember Black-Scholes formula? S into ND1 minus E into e to the power minus RT into ND2 into ND2 into ND2. Okay, solve. Please solve. S is 160, ND 1.646. So first you do this calculation minus this calculation. Black-Scholes model, we have taken many questions in the classroom, many questions in the derivative option topic. And now check the answer. Check the answer. 160 into 0.646, 103.36, 200 into 0.7788 into 0.384 equal to. So what is your answer now? Is it approximately 43.55? Is it approximately 43.55? Right? 43.55. So this is the answer of this question. So we have taken many questions on real options. We have taken many questions on real options. Now the next part of this chapter is normal distribution curve and capital budgeting. We are going to discuss normal distribution curve. In the next lecture, you will bring the normal distribution table. If you have normal distribution table in any book, you will bring it. If you have our class notes, then normal distribution is there at the end of the booklet. You will find towards the end there is a normal distribution table. Is it right? This page you will keep in mind. Normal distribution table. Okay. So I will require it. Those who don't have will bring this normal distribution table in the next lecture for more understanding. Anyway, so what is a normal distribution? As you know, if data is drawn on a diagram, if mean is in the center, data is normally distributed. Normally distributed means some portion of the data is below the mean, some portion of the data is above the mean, and it looks like a symmetrical reverse bell shape. Okay, it is like a bell shape curve and both sides are symmetrical. 50% of the data fall below the mean and 50% of the data fall below the mean. This tail will not touch the x-axis, but it will extend infinitely. The purpose of the normal distribution is we can find the probabilities of a certain variable by looking at the normal distribution table. Knowing the probability helps us to understand the risk. If NPV of a project will be negative with 0.2% probability or 5% probability, I will say risk is less. But if NPV can be negative with 100% or 90% probability, I will say risk is more. So that is the normal distribution curve. First we will read few notes today, then question answer we will take in the next lecture. Normal distribution is a mathematical distribution for dealing with the quantities whose magnitude vary continuously. That means the variable can acquire any value. It can range from minus infinity to plus infinity. Continuous variable can assume any value over an interval. That means its value can be anything between minus infinity to plus infinity. Important features of normal distribution. Now first of all, I'll tell you it is not a mathematics or statistic subject. Only we need to understand how to get the probability out of that normal distribution table, and for that I am doing some groundwork. Otherwise all this you don't have to remember. Once you know how to use probability, my task is over. So important feature is the normal curve of a normal distribution has a single peak. So you can draw this diagram. You have got 3 boxes on the right side for drawing the diagram. So you can draw the diagram here and you can write this is the single peak. It is unimodal. There is only one mode. So mean, median, mode all are in the center. It is bell shaped. Can you see the shape? If you go to some temple, you will find bell shape. Bell is like this and it has a highest point over the mean. It is symmetrical about a vertical line through a mean. Symmetrical means the left side and the right side are exactly identical. That is symmetrical. Most of the human beings are also symmetrical. Today you see yourself in the mirror and draw a line from the center, you will be amazed. You are symmetrical. Okay, your left side and your right side are exactly equal. Not everybody. Okay. the two tails of the curve extend infinitely. So when you draw the diagram, don't touch the x-axis. If you touch the x-axis, it's a wrong diagram, and never touch the horizontal axis. For a normal distribution with mean mu, mean is written as mu and standard deviation sigma, the total area under normal curve is 1. Total area is 1 and 50% lies below the mean, 50% lie above the mean. How to use the normal distribution table? Understand, a random variable which has a normal distribution with mean 0 and standard deviation 1 is called a standard normal distribution. A standard normal distribution means mean is 0 and standard deviation is 1. That table that you saw just now deals with standard normal distribution, but every distribution will not have mean 0 and sigma 1. So you have to convert them into standard normal distribution. You will have to convert them into standard normal distribution by applying this formula. Before that, point 8, area under any normal curve is found from the table of standard normal probability distribution, showing the area between mean mu and any value of the normally distributed random variable. You have seen one normal distribution table. For those students who have the book, you will find it at the end of the book in the mean. And suppose I want to know what is the probability. Suppose mean is 10 and this is 20. What is the probability that a number will fall between 10 and 20? What is the probability that the number will fall between 10 and 20? The normal distribution table will give you the probability of a number falling between mean and a certain number. Similarly, you can find what is the probability that the number will fall between 5 and 10, where 10 is the mean. You can use the normal table to find that. If the mean is not 0 and standard deviation is not 1, then I have to convert them into standard format first. How do I convert a given data into standard format? I will compute z value. Z is equal to the given number that you want minus mu upon sigma. Okay, for example, suppose mu is 100, sigma is say 200, and I want the probability of a number between 50 and 100. So I will take 50 minus 100 divide by 200. How much is the deviation from the mean per unit of standard deviation? How much is the deviation from the mean per unit of standard deviation? So that is your 50 divided by 200, 0.25. So I will go to the normal distribution table and find the value of 0.25. That will give me probability. 0.25 is not the probability. You will use 0.25 to search in the normal distribution table. Okay, point number 10. The value of z in the table of standard normal probability distribution represents the probability for various points along x-axis. So the normal distribution tells you probability of a number between mean and a given number. Between mean and a given number. If you want the probability of this area, refer the normal distribution table. Point number 11, normal distribution curve is divided into two halves. When you draw the diagram, it should look symmetrical. Left side of the mean, right side of the mean, and the area is 0.5. So if somebody asks you what is the probability that number will be less than mean, answer is 0.5. What is the probability that number will be more than mean? Answer is 0.5. Then no need to calculate. Point number 12, if z is positive, what is the meaning of positive z? If z is positive, suppose mean is 100, sigma is 200, and the value of x is 150. If I want to find z, I will take 150 minus 100 divided by 200, say 0.25 positive. If z is positive, it means the number falls on the right side of the mean. If z is positive, number falls on the right side of the mean. Okay. And if the z is negative, suppose my x is equal to 50. If x equal to 50, the value of z will be 50 minus 100 divided by 200 minus 0.25, which indicates the moment you get z negative, it means the number is on the left side of the mean, below the mean. Positive z, number is on the right side of the mean. Negative z, number is on the left side of the mean. Now you can draw one more diagram in your book. If the value falls on the left tail, suppose the value is here, and we have to find right of the left tail, we have to find this probability. We have to find this probability. What do I do? Area of right side of the mean is 0.5. We will find table value, and the probability will be table value plus 0.5. If the number is on the left tail and we have to find right of the left tail, this diagram you will draw in the second box. Table value plus 0.5. And the last point number 14. If the value falls on the right tail, suppose x is here, and we have to find left of the right tail. How do I get probability? The probability of left side of the mean is 0.5. Find table value. This is your third diagram, and the probability will be same, table value plus 0.5. Probability will be table value plus 0.5. These are the diagram you draw. Depending upon the question, we are going to draw the diagram and understand for which area we need the probability, and accordingly I will solve. Is it right? Not a very difficult thing, very easy, totally formula oriented. So now we'll continue tomorrow, same time, don't miss it. Tomorrow we are going to take very important question on normal distribution. Thank you very much. See you tomorrow.